Moving on to section 4, covering the contract notes, statement of account and receipt rules. Now, this, if we move part of the way down, section 4.1, says that intermediaries must provide to their clients in English or Chinese. Internally, it can be one or other language. You must provide contract notes, receipts for client assets received, monthly statements summarizing all activities, and if appropriate, daily statements of financing arrangements. Now, these rules are relaxed with regard to professional investors, and the 2 points at the bottom of page 11 should be noted. If PIs, this is professional investors, are defined in the SFO, that's the big institutions, the banks, the insurance companies, etc., the intermediaries inform them in writing and the clients do not object. If that is the case, then these rules do not apply to those professional investors. So these are what we call the institutional professional investors. Then says that the rules will not apply if the PIs are defined in the professional investor rules, and that's corporate professional investors and individual professional investors. In those cases, the clients have to have agreed in writing not to receive the documents. I would say those are side points, but the questions have popped up, not regularly. So I'd be aware of those 2 points. Starting with contract notes. Okay, right at the top, we're told contract note must be issued whenever intermediary buys or sells shares, including transaction under securities borrowing and lending agreements. Contract notes have to be issued. And the time frame, it's by the end of the second business day after the transaction. That is T+2 for contract notes. And we've listed there what a contract note should contain. A daily statement of account is only relevant if securities margin financing is involved. Now, the statement will be prepared, the 2 sub-bullet points there, by intermediaries that provide the securities margin financing or by intermediaries conducting margin transactions, both when the transaction entered into and when it's closed. So the first one is the actual provision of the finance. The second is where you're conducting the trade. You are the dealer and the securities margin financing is involved. And again, it is T+2, daily statement must be issued, client no later than the end of the second business day. Now, daily statements are not issued by everybody. The classic would be the Type 8 license, securities margin financier. So tuck that in the back of your mind. Monthly statements of account, on the other hand, must be prepared by an intermediary for all clients. Now, when must you issue the monthly statement? Right at the bottom, 2 bullet points. Well, it's actually the second last bullet point. Monthly statements must be issued within 7 business days of the end of each monthly accounting period. When we move on to fund management, asset management, that is extended to 10 business days. So fund managers, their monthly statement issued within 10 business days, but that's probably not going to arise at paper 2. You should be aware, normally it's within 7 business days. Receipts must be issued by the end of the next business day after the day of receipt. So it's T+2, clumsy way of referring to it. Now, record retention. All statements, the default is that all statements must be kept for a minimum of 7 years. However, there's an exception in that the time period is shorter, and it's recorded there under section 4.6. Contract notes, daily statement and receipts must be kept for a minimum of 2 years. Otherwise, it is 7 years, including monthly statements. Let's move on to the keeping of record rules. The keeping of record rules really stipulate the accounting records that you have to keep if you are an intermediary. The records that you have to keep are listed under 5.2. That is for all intermediaries. And then under 5.3, we've highlighted the records that should be kept by associated entities, and 5.4, those that should be kept for securities margin financiers. Now, there's an outside chance that a question could dig into the detail of 5.2, 5.3, 5.4, but it would be unusual, to be honest. And then 5.5, other issues. Well, we've just sort of summarized the length of time that you've got to keep the records for. I just previously covered this. By default, the general rule is 7 years, and then 2 years for daily statements, records documenting orders, copies of contract notes. Documentary assurance for short sales, we'll come across that in topic 5, but we've highlighted 1 year here. Once again, we're told that the records to be kept in Chinese or English. Now we come to the accounts and audit rules. Now, these are not regularly examined, but these are outlining the requirement to have a statutory audit and give some of the applicable timeframes and what you must report. Also, an auditor's report up at 6.2. An auditor must provide the normal true and fair opinion as to whether or not the accounts show a true and fair view. But when auditing a licensed corporation, the auditors also got to report on accuracy of the returns made with regard to financial resource rules, keeping of record rules, client securities rules, and client money rules. Now, I mentioned earlier that compensation and insurance rules are important, especially with regard to the Investor Compensation Fund. Now, the Investor Compensation Fund was set up in 2003 through 3 subsidiary rules there. You can see them, the Investor Compensation Levy rules, claims rules, and compensation limits rules. Now, the purpose of the Investor Compensation Fund is to provide an element of insurance for retail investors who lose money because of the default of intermediaries. Now, the SFC set up the Investor Compensation Fund company, and we give details of that company under 7.1.1. And there's some important points here. The fund that was set up under sub-bullet point 3 there by buyers and sellers being charged a levy of 0.002% to fund the compensation fund. That levy only existed until 2005. It has been suspended. And the bullet point at the bottom of page 16 relates to this. Levies waived when the net asset value of the funds exceeds 1.4 billion, reinstated when it goes below 1 billion. Well, it has never been reinstated since 2005. Now, who can claim against this fund? Well, these points are important. Claim may be made on the fund by a client of a covered intermediary who sustains a loss due to a default of the intermediary. Default defined bankruptcy or winding up of the intermediary, or any breach of trust, defalcation, fraud, or misfeasance committed by the intermediary or its employees. And if that occurs, the investor, well, it's retail investors only, can claim against this fund. And that's highlighted there by the last bullet point under 7.1.2, institutional investors not entitled to claim compensation. Are there any limits on what you can claim? Yes, under 7.1.3, maximum 150,000 for loss in securities, but also 150,000 for futures. So combination, a maximum of 300,000. So be aware of the major points there. The fact that the Investor Compensation Company runs a fund. It's only retail investors that can claim against it if there is a default by an intermediary covering bankruptcy, winding up, etc. And that the maximum claim is 150,000 for securities, 150,000 for Futures. Insurance for intermediaries under 7.2. The main point to remember is that it's only intermediaries that hold client assets that require insurance as a requirement of their licensing. And that is because you're insuring against the loss of these securities. Page 18 covers a relatively new area, that is the contract limits and reportable position rules. And it says under 8.1, first bullet point, these rules seek to prevent, discourage the large buildup of derivative positions that could adversely affect orderly functioning and stability of the market. And the third bullet point there, we're told the rules primarily operate by specifying reportable positions being aggregate number of open positions in futures stock options contracts that reach a certain level, and prescribed limits being limits on aggregate number of future stock options contracts are going to be held or controlled. So I think I need to be aware of why they're there, and maybe some of the detail, but not all of it, but read through that in your own time. Yeah, I would say we're probably just a little bit too much material there. Topics 9 and 10 relate to over-the-counter derivative transactions. First of all, 9 looks at the reporting rules where if your OTC derivative positions hit a particular threshold, then you must report. What is the threshold? It's under 9.3.3 under page 22. It says exemptions. A licensed corporation is exempt from the reporting requirement if notional amount of all outstanding OTC derivative transactions in aggregate does not exceed 30 million US. So if you're below 30 million US in terms of the notional amounts of your derivative transaction positions, then you do not have to report. Once you go above 30 million US, the exemption is lost permanently. So even though you go below 30 million again, you must continue reporting. Now, what does reporting mean? Under 9.3.1, we learn that all transaction information with regard to these OTC derivative positions must be reported to the HKMA via the Hong Kong Trade Repository, and that system is operated by the HKMA. So you are reporting significant OTC derivative positions to the HKMA. And the reason they want to know is from the point of view of market liquidity, to know where potential problems may exist. We then go on to the mandatory clearing, and mandatory clearing under section 10 of OTC derivative position, there are a separate set of rules for this, is where the OTC derivative position is particularly large. If we look at 10.2, where an OTC derivative clearing obligation exists, transaction must be cleared through designated central counterparty within 1 business day of the transaction. I don't think we need to worry about who these central counterparties are, but what I think you need to be aware of is what the monetary threshold is again, and that comes under 10.3, the second bullet point, as the regulatory objective is to catch systemic risks posed by larger and more significant participants in the OTC derivatives market. The clearing rules only apply to positions of $20 billion US or more. So we're talking very, very large OTC derivative positions. And if you face such a situation, you must clear through a clearinghouse, mandatory clearing obligation. And then finally, section 11 on enforcement actions. This really is bringing to life some of the actions that have taken place. And you can see case 1 and 2 under the financial resource rules, case 3 under the client security rules, and case 4 under the client money rules. You're not going to need to remember the detail of those cases, but it just brings to life the legislation the subsidiary legislation that we covered at the beginning of topic 2. Topic 2, important in terms of volume of material. It's not as great as some of the other topics, but you will get a fair number of questions on these rules. As I've said before, I'd be fully familiar with financial resource rules, client security rules, client money rules. And I'd have an awareness of the contract note, the monthly and daily statement rules. The accounts and audit rules, I wouldn't be too concerned about. Keeping a record rules, yes, I would be aware. And the remainder of the material, well, again, question practice should suffice. And once again, I would recommend that you go to Examinator.online paper 2 to encounter a number of relevant questions which will help with your short-term memory for the exam.